Namaste everyone. Welcome to EPK Capital's Daily Market Brief. Today is Tuesday, November 18th, 2025, and we are breaking down one of the most nervous trading days we've seen in weeks. If you looked at your portfolio yesterday, you saw a sea of red. The session on Monday, November 17th, was defined by three massive stories. A brutal tech-led sell-off, as investors are absolutely terrified ahead of one key earnings report. A divided Federal Reserve, with two major governors giving completely opposite signals on future rate cuts, creating total confusion. A crypto crash that's accelerating, with Bitcoin plunging to its lowest level in months and dragging related stocks down with it. It was a classic risk-off day where investors sold first and asked questions later. But we have the answers. We're going to dig into all the numbers, the why behind the moves, the major political comments, and what you need to watch for today. Let's get right into it. Let's start with the damage report. The closing numbers from Wall Street on Monday were not pretty. The S&P 500 plunged 61.70 points, closing down 0.9% at 6,672.41. The Dow Jones Industrial Average took the biggest hit, dropping a hefty 557.24 points, or 1.2%, to close at 46,590.24. And the tech-heavy Nasdaq Composite fell 192.51 points, or 0.8%, to finish the day at 22,708.07. This wasn't just a US story. The negative sentiment was global. In Europe, London's FTSE 100 slipped about 0.1%, and Germany's DAX fell 0.4%. The pain was felt deeply in Asia as well. Japan's Nikkei 225 fell 0.1% to 50,323. And in China, Hong Kong's Hang Seng Index dropped 0.7%, while the Shanghai Composite lost 0.5%. So, the obvious question is, why? What spooked the market so badly? The number one driver for yesterday's sell-off can be summed up in one word: Nvidia. The entire market is holding its breath for Nvidia's earnings report, which is due out after the bell this Wednesday. Nvidia has been the undisputed king of the AI boom and the primary engine for this year's market rally. Its stock was the heaviest weight on the S&P 500 yesterday, falling another 1.8%. This isn't just about one company. Investors are treating this earnings report as a referendum on the entire AI frenzy. The fear is that Nvidia's growth, and especially its guidance for the future, cannot possibly live up to the sky-high, perfection-priced expectations. If Nvidia so much as hints at a slowdown, it could pull the entire tech sector down with it. And yesterday, investors decided they didn't want to be holding the bag if that happens. We saw a major rotation out of high-flying tech and AI names. But it wasn't just AI. We saw two other tech-related sectors get hammered for very specific reasons. First, the PC hardware makers were a disaster. Dell Technologies stock absolutely cratered, dropping over 8.4%. Hewlett-Packard Enterprise fell 7%. HP was down nearly 6.8%. The reason? A devastating note from Morgan Stanley. The investment bank downgraded all three stocks, warning that surging prices for memory components are going to squeeze their gross margins and crush their profitability. Second, the online travel sector hit an air pocket. Expedia shares dove nearly 8%. Booking Holdings also slid. The culprit here? Google. Google just launched new AI-enabled travel tools designed to help users build entire customized itineraries, integrating flights, hotels, and reservations. This is a direct shot across the bow at the online travel agencies, and investors fear Google's AI is about to eat their lunch. And speaking of Google, in a day filled with tech carnage, there was one massive bright spot. Alphabet, Google's parent company, defied the entire market. The stock hit an all-time intraday high and closed up 3.1%. Why? Because a new 13F filing revealed that none other than Warren Buffett's Berkshire Hathaway bought a massive new stake in the company. We're talking 17.8 million shares, a position worth over $4 billion. This is hugely significant. Buffett and Berkshire are famously value investors, often skeptical of high-flying tech. For them to make a multi-billion-dollar bet on a Magnificent Seven stock, one that's already up big on the year, is a massive vote of confidence. It signals that the Oracle of Omaha believes Google is not just an AI-hype stock, but a durable, value-generating business. It was the one piece of good news in an otherwise terrible day for tech. All right, let's move from individual stocks to the big-picture macro environment, because this is where the real uncertainty is coming from. First, the 43-day U.S. government shutdown finally ended last week. But now, the market is bracing for the data flood. We are about to get a massive backlog of delayed economic data from the Bureau of Labor Statistics. This includes all the crucial inflation and jobs reports that we've been flying blind without. This data will determine the Fed's next move. And speaking of the Fed, yesterday we got a perfect example of why the market is so confused. We heard from two major Fed officials, and they said completely opposite things. First, we had Fed Vice Chair Jefferson. He gave a very cautious speech. He said the Fed needs to proceed slowly with any more rate cuts. He acknowledged that downside risks to employment have increased, but basically signaled that the Fed is in no hurry to ease policy further. This is the hawkish or patient camp. But then, just a few hours later, we heard from Fed Governor Christopher Waller. Waller, who has been pushing for cuts this year, came out and said he favors a rate cut in December. He argued that a cut would provide insurance against a weakening labor market. And he made a fascinating and very populist comment. He said, and I'm quoting, "While the booming stock market is supporting spending by a narrow band of well-off consumers, it does not reflect financial conditions for most Americans, and that is a vulnerability." This is an incredible statement from a Fed governor. He's essentially saying the AI-fueled stock market boom isn't real, it's not helping the average person, and it's not a sign of a strong economy. So what does this mean for you? It means the Fed is openly split. Jefferson says slow down, Waller says cut now. This division creates massive uncertainty for investors, who have no clear signal on the future path of interest rates. And as we all know, the market hates uncertainty. Now let's talk about the other major risk-off signal flashing red, the cryptocurrency market. This isn't a dip, it's a plunge. Over the last 24 hours, Bitcoin has fallen to its lowest level since April, crashing down to trade around $92,000. Remember, this is after hitting an all-time high of over $126,000. This crypto crash is starting to genuinely scare investors, especially those who are highly leveraged. This risk-off sentiment is spilling directly into the stock market. The main victim is Coinbase. The crypto exchange's stock is tied directly to the price of Bitcoin, and it got hammered yesterday, losing about 7% of its value. This sell-off in crypto is a major indicator that investors are pulling back from their most speculative assets, and that bearish sentiment is bleeding over into the broader tech and growth stock sectors. Zooming out, there were two other major global stories you need to be aware of. First, Japan's economy is in trouble. The government released new data showing that Japan's GDP contracted at a 1.8% annual pace in the third quarter. That is a significant contraction for the world's fourth largest economy, and it's weighing heavily on the entire Asian market. Second, geopolitical tensions are rising in East Asia. There's a new diplomatic spat between China and Japan. It started after Japanese Prime Minister Sanai Takaichi suggested that a Chinese military move against Taiwan could provoke a Japanese military response. China, as you can imagine, reacted very strongly and has now warned its citizens against traveling to Japan. This rising tension is adding another layer of risk to global sentiment, and it's one of the reasons the Hang Seng and Shanghai markets were down. Let's do a quick lightning round on commodities and currencies. The US dollar. The dollar was up yesterday. In a risk-off environment, cash is king, and investors fled to the safety of the dollar. The US dollar to Japanese yen cross actually rose above 155. Crude oil, WTI crude, was down about 0.5%, settling just under $60 a barrel at $59.80. Fears of a global economic slowdown are outweighing supply concerns. Gold, even gold, typically a safe haven, couldn't catch a bid. It fell 1.4% to $4,035 an ounce, likely due to the surging strength of the US dollar. So, what are we watching for today, Tuesday, November 18th? The market is still on edge. All eyes are on the first bits of delayed economic data. We are expecting the ADP employment change report, which will give us the first real glimpse into the health of the job market post-shutdown. The forecast is for a loss of 11,000 jobs. We also have a slate of major retail earnings this week from Home Depot, Target, and Walmart. These will be our best look at the health of the U.S. consumer. But ultimately, everything is just a warm-up act for Nvidia on Wednesday. That is the main event. So, to sum up a very wild 24 hours, we have a market selling off hard on tech valuations, led by extreme nervousness ahead of Nvidia's report. We have a Federal Reserve that is completely divided on its next move, giving investors zero clarity. And we have a crypto market that is in a full-blown plunge, signaling a major retreat from risk. It's a nervous, volatile, and fascinating time to be in the markets. That's all the time we have for today. Now I want to hear from you. What's your move here? Are you buying this tech dip, or are you selling and heading for the hills? Do you think the crypto crash is an overreaction or just the beginning? Let me know your thoughts in the comments section below. If you got any value from this analysis, please do me a huge favor and hit that like button, and be sure to subscribe so you never miss a daily market briefing. Thanks for watching, and I'll see you tomorrow morning.